hard, it's labor intensive, the infrastructure is not in place, and it's very, very hard to secure properties when you're competing with private investors who are paying all cash for those properties. But that would be the one area that I would urge further thought about how we can respond and make a little lemonade out of the lemons that we have in this foreclosure process.
Well, I want to thank the panelists, and if Senator Wright has any questions, I have a couple, but mostly I just sort of, as we wrap this up, since this was the first hearing for me as chair of the committee, this is the Housing Committee. So what I'm really interested in is more the macro side of things, what Mr. Levy talked about, but also how we could work collectively to deal with that in a thoughtful way. So the housing market, as Mr. Levy said, has changed forever. We know that for financial purposes and purposes of demographics. So how does the state of California and the state Senate, working through this committee, at least have a thoughtful process to look at how our laws and our regulations affect that in a positive way? It's not to have hearings that are gotcha hearings, but to have a series of hearings that are informational, that will lead to policy changes, given that the world has changed. And I think some of that will impact energy and transportation policy as well. And I thought the first testimony from Mr. Levy was actually, in as much as it was off the subject matter of foreclosures in the California housing market, was a nice way of framing what I hope this ongoing discussions are. And that's not to ignore the fact that there are individual things that we can do in this state to help us through the process. Having said all that, to Mr. Gould in particular, it's just the transparency of the process. So you'd like, both of you have mentioned the non-judicial aspects, and if you were to give which I disagree with, but if I'm choosing my words here, that we need to go through the marketplace and sort of get the people or get the individuals who can't afford to live in their homes through that process. If that were true, it seems to me that you would argue for as transparent a process as possible that had the least amount of litigation. And just intuitively to me, I think that's what most Californians who are in their home want. They might want to stay there and live forever, first off, but they also recognize that the world's changed, and whether they're underemployed or unemployed, they want to figure out a process that's fair, but there are parameters. And I must say that in the time I've been elected office, it's always sort of strange to have an industry say, we believe in the market, let it play out, and then you cite to a consent decree or some process that you fought, and then sort of say, well, see, things were working out fine. So it seems a little counterintuitive to say both those things. So having said that, how do we set up a process where conservative, liberal members of the California legislature would help fix the housing problem in California, prepare for it in such a way that there's a transparent, fair due process that is efficient? Because it does strike me, just not having the one point of contact, if I were in your shoes, it seems incredibly inefficient. Makes me wonder, is there a purpose to this inefficiency? Is it to avoid litigation? Is it sort of to wear down the client who's calling? Because most of the people who I talk to, and there's quite a few, are frustrated just that there's no clear parameters and they can't talk to anybody.
Mr. Chair, if I could just respond, I don't think industry's position has been to rip the Band-Aid off as it was characterized previously. I think industry, as I tried to suggest in my testimony, has demonstrated a willingness to sit down and try to find solutions to try to keep borrowers in their homes. As I indicated, we've seen no less than 36 measures that have been enacted in the state of California to try to address that problem. I think what we're finding is that we're near the end of providing loan modifications. There are still going to be folks who should be helped, who have an ability to pay and have an interest in staying in their homes. And we very much want to do those kinds of modifications where we can make that happen. I think industry has demonstrated a strong willingness to do that. What we're disinterested in doing appears to be a trend over the last year where some of the efforts don't really address trying to deal with the borrower's underlying financial circumstances, but merely drag out the process longer through additional procedural hurdles and litigation. Such legislation that was discussed, in our view, does those things. Drags out the process, imposes litigation into what is supposed to be a more simplified non-judicial foreclosure process. We don't think that's a helpful outcome. In those cases where you can't help a borrower, unfortunately, you have to figure out how to transition through that so that you can get through that inventory. I just want to make sure that that part is clear.
And maybe it's to Pat, but if we're changing the world of housing on multiple levels, demographics, but also how we finance it. So if it's true that we're not going to have 30-year fixed mortgages for most people, and then on the other hand, one of you talked about having more venture capital or people coming into the market who are going to want to make more than 3% return, then we as a housing committee have to sort of anticipate that that is going to have an impact on our housing. So again, intuitively, it would suggest to me that we're going to have more rentals in California.
And I think that was the posture of Treasury Secretary Geithner when he was explaining the policy to unwind the federal government's involvement in the GSEs. I think they acknowledge that there is a fundamental policy switch, which is we might see less home ownership opportunities and more renters. Pat talked about the interest rate risk. That's what it is. It's very fundamental banking. If you have an interest rate environment at 4 or 5% that escalates above that, you would expect, your depositors would expect in that growing interest rate environment that you would pay them more on the deposits. To the extent that your deposits exceed your income from your loans, which is the assets, your earning assets, you can't make it a profitable adventure. So that's the interest rate risk that we're talking about, and that's the concern that's being discussed with regard to a 30-year fixed-rate mortgage. I'm not suggesting that they're going to go away. That is being discussed out there, as you referenced in the New York Times article. But clearly, I think it's fair to say that on a go-forward basis, mortgage finance is going to get more expensive as the federal government scales back their interest.
Well, that goes to, we can tell who reads the New York Times, Paul Krugman's article yesterday in the magazine about emerging Brazil, China, and India, emerging economies, and the fear of inflation. So that all of those things will play out. But that for us, liquidity and being able to build those rental units, for us, as our purview as a housing committee, is something that we have to understand.
Mr. Chair, I just wanted to go back to, I think, some of your questions. The one thing I really want to reinforce, one takeaway, is that from a marketplace perspective, consistency and stability is critical, especially when you're trying to attract capital to this market. And one of the things that we've seen over the years is bills that we thought were relatively simple. 1137 has been referenced a few times, and I'll mention one other one. As far as creating consumer outreach prior to filing the NOD, we thought that was a very simple process. We work with the consumer groups, we work with the author to develop a compromise. What we believe now has resulted is all of those outreach efforts become a question of fact with respect to litigation, and that's what we've seen start to happen regarding the foreclosure process. Is it's drawn out the process, it's created litigation in a form that I think most never expected. The other interesting thing on that bill is, if I remember correctly, the private right of action was expressly taken out of that bill. Yet in court cases, the courts determined that there still was a private right of action involved. Those are unintended consequences that have a dramatic impact on the marketplace. Another one I just want to bring up briefly, there was a bill a few years back to prohibit advance fees with respect to modification services, which passed and went into law. I think one of the unintended consequences of that is we started to see attorneys who used to be involved in providing modification counseling start to file litigation because they couldn't collect an advance fee with respect to modification services, but they could file a court case that would delay the process 2 or 3 or 4 months and be able to collect attorney's fees. So I just want to bring up these points in that I think even bills that we thought were very simple and worked with the author and consumer groups have unintended consequences to the marketplace, which I think will have a dramatic impact on the housing market on a go-forward basis.
Thanks, Pat. And I know you're talking about the state level, but for people who say you want consistency in the business model, you can argue the other side of that on a national level. Granted, you're talking about state level. You know, we suspended a lot of the regulatory oversight that we put in place in this country after the 30s, like Glass-Steagall. You know, people were happy making 3 or 5%, and there was a model there. I understand there was an argument for larger growth, but it's, you know, we want consistency. Then lots of times the market, some of its actions isn't consistent with that. I mean, it's just human nature. I'm not finding fault. I'm just saying human nature doesn't always want consistency, not so much on a state level, but on a national level. You two have been biting your lip, and then we're going to ask Senator Wright if he has anything, and I'll be quiet.
I just want to say I think it is a little bit premature to predict what the nature of our housing finance system is going to look like going forward. I think the debate on the future of the GSEs is in its early stages, and I think that the idea that there will no longer be a government guarantee on some sort of conforming loans that will allow 30-year fixed-rate mortgages to exist it's a premature conclusion to reach, and I think that the terms of mortgage lending going forward, but for some of the details and changes and protections that were included in the Dodd-Frank Act, including the formulation of a Consumer Financial Protection Bureau that will provide an ongoing monitoring function that is interested in the protection of consumers rather than first and foremost in the safety and soundness and profitability of the financial institutions, is a huge change. But I don't think we should conclude now in advance that if we have some degree of accountability and transparency in loan servicing, that's going to add some costs to California's foreclosure process or mortgage origination process that's going to stop capital from investing in California home ownership. I just don't believe that to be the case.
Thanks. Senator Wright, do you have any comments? Welcome to the Transportation and Housing.
No, I'm like a bad penny. I'll show up. But I think we have to be careful of a couple of things. I know in many communities that I represent, you can't get a loan now because of the uncertainty. Banks simply say, unless you can put down 20 to 30% and your FICO score is plus 800, we're just not lending money. I actually would argue the other way from your argument. Foreclosures actually have a benefit to the system. That being, it lowers the price of the house. I mean, I've got people who live in Compton who paid $700,000 for a house. You could buy Compton for $700,000. City Hall, the McDonald's, I mean, clearly when you got the prices jacked up that high, several things were going on that didn't have anything to do with housing. I mean, I kind of look probably different than some people. I've been an apartment owner and a real estate investor for the better part of 35 years. I just look this old, but I'm real. But part of the challenge became, and it goes back to when they changed the rule about how much you could deduct off your active income from real estate, and it went from an unlimited number down to 2. And then the discussion started about taking the mortgage deduction off of it altogether. And then we attacked savings and loans, and we ran them out of business because savings and loans provided what used to be most of the capital to housing. Housing is not a particularly profitable venture to people who are investing their own cash. It's profitable on the retail side, but on the mortgage side, it never was a good investment. That's why savings and loans were developed in the first place, because banks kind of said, we're not going to make a 30-year loan and have our cash tied up for that period of time. Savings and loans didn't assume the same risk. They couldn't do checking accounts. There were a lot of restrictions on them. But the risk on that capital and the reward that they provide. In the old days, most people used to have a savings and loan for their savings and a checking account to pay their bills, and you maintained the two because you didn't have to pay the taxes on the money you put in the savings and loan. It was specifically designed to do that. Fannie Mae kind of created a secondary market, so they too assumed the government some of that risk. We've never had in this country a system on a mass scale where private capital provided mortgage loans, and we never will. It's not a good investment that people would make. What I hope we'll try to do is that we're not careful. I think what the chair described is that we'll simply drive people out of home ownership, because at a 30% down payment requirement, the number of people who can afford to buy a house will be real small. I mean, and we've blown past. I mean, I watched it go from 20 to 15 to 10 to 5 to 3 to nothing. Clearly, you can't purchased something with no skin in the game. But now I'm watching it go 5, 10, 15, 20, and it's still climbing. So if you get down payment requirements where the loan-to-value ratio is going to go below 70%, you won't have but a few people who can buy a house anyway. I mean, which is scary. So what I would hope we would look at is a couple of things. If people lose their houses, I mean, there's clearly a relationship between unemployment and foreclosure. There's also a relationship that we're going to have to fix on another issue, which is a good percentage of the people who are losing their homes are not losing them because of the original mortgage. They're losing them because they took out seconds and thirds and jacked up the value beyond what they could afford to pay. There are clearly some who got, 5-year interest only, but a good percentage of the people who I'm looking at who are losing their homes, it is the refi that got them, where they took cash out that didn't have anything to do with their purchase of the home. Most of those people, for example, were not underwater in the original mortgage purchase. They became underwater in the refi or the second mortgage. I think we should look at, for example, the kind of marketplace that we allow for refis and seconds as a factor over the basis price over which you bought the house in the first place. Because I don't know that in our system we can afford to have a system where the house is an ATM. Because once it becomes an ATM, eventually you will borrow up all the money and take out all the equity and you'll be upside down. I think we've got to do a number of things. If what we desire is to have home ownership as a desirable goal, from all of what I've seen on Wall Street now, the desire really is to move Americans out of home ownership because it's more profitable for Wall Street to have a few investors who do rental housing and have most people as renters. And then in that same vein, they would remove the mortgage deduction, which would then make it less desirable to own a house, at which point we've basically surrendered housing back to Wall Street because you'd only have a few people who'd be able to play. I am a person who believes home ownership is important. I like the idea, for example, that we were working with lower income people to get homes. Clearly the risk of that is that you have a greater foreclosure incidence in much of those. Now, in some cases, they got a bad loan. I mean, because I could take you to Watson Compton, and when you look at, a guy who got an interest-only loan for 5 years and then it turned into 12% at the 5th year, well, that loan clearly wasn't going to last him for very long because at 11%, he was going from paying maybe $600 or $700 a month to $2,600 a month. And if he didn't make but $2,000 a month, he was $600 behind on his ability to pay. I think we want to say to people, as you did, if your house, if you can afford to pay the note, I don't care whether or not you're underwater. It should almost be an irrelevant discussion. The question is, can you afford to live in the house? Because if you sell it, you're going to go someplace else, and rent insurances are, you're going to pay almost as much as you were paying anyway. So if you can afford to stay in the house and pay the note, take the mortgage deduction, or if you decide you just want to give it up because you're underwater, but we're scaring people now by saying, oh my God, you're underwater. You're not getting the same value that you used to get. So I would hope we would not make loans so restrictive that only a few people can afford to buy houses. I would hope that we would not make foreclosures so restrictive. I mean, I'm clear that you had so many bundled foreclosure notices that we've never had this volume, and so people were just kind of doing it and taking the fast track. But even in that consent decree, none of the houses that were in the consent decree that I reviewed, they still were houses that needed to be foreclosed on. The fact that the paperwork was shoddy, the house was still going to get foreclosed on, so we just kicked the can down the road. I mean, if you haven't paid your house note in 5 or 6 months, you're going to lose the house at some point anyway. So again, I agree that you should have the proper owner should be the one filing the action. But if you haven't paid your house note in 6 months, then you pretty much know you're going to lose the house. And the same thing that scares me in my neighborhood is I've got banks that won't foreclose and won't move forward, or they will foreclose and don't want to resell the house. So in some instances, they just put the person out of the house for the purpose of holding on, thinking that the government's going to bail them out because they've got a house that really is worth $150,000, but they're holding out that the government is going to buy it for $3,000, at which point it's more profitable for them to wait it out, which is now driving down the property values in the neighborhood, and it's making the quality of life difference. So I'm probably a little different than a lot of people because I bought some foreclosures in my life and made money doing so. Again, it's bad whenever anyone loses their home, but again, a good percentage, I can't say what percentage it is, or refis and second mortgages. I don't have the same sympathy for that guy. I mean, I'm looking at a guy who bought a nice car and took a nice vacation and had a great time, and he lost his house. Well, he made a choice, unfortunately. It was a dumb choice, but it was a choice that he made. If that house got foreclosed on and it sold for the $150,000 that it was really worth, then I could put a police officer or a teacher in that house and stabilize the neighborhood. So, and while it's unfortunate that he lost it, that's tough. I don't want to prop up the banks by making all of those extensions either. I mean, and it's not just banks, because I've got guys Deutsche Bank is a huge mortgage holder in South Los Angeles. The city attorney is suing them. At the end of the day, there are a lot of things I think we do. I think we need to step up foreclosure processes in those and resell them. And I'd even like to give a preference to people who are interested in buying them not in aggregate for resale, but people who are interested in buying them and living in them. I mean, in the old days, we used to give a preference to an owner-occupied residence. I'd go back to that kind of thing. If you intend to buy it and live in it, we should help in that process. We're now hindering it. And by stretching out the process, what I'm finding is that the loan that would have been available in South LA and in Compton and in Watts simply isn't available anymore. And because if white folks get a cold, black folks got pneumonia. And so I'm fearing that there is an economic pneumonia about to take over in my neighborhood. And I know I said a lot and I took too long for somebody who isn't even on the committee, but it's a fear that I have of just watching a kind of economic disillusionment of a whole neighborhood. And predominantly, I'm talking about people who are low to middle, teachers, police officers, government workers who come in on the margin of their ability to purchase and can't do it when the value of the house exceeds $300,000 or $400,000. I'm sorry, I didn't take it.
Well, I just wanted to respond on one thing, and I know I will end up sounding like I'm just beating a dead horse, but I think that, when you talk about, and I agree with you that I don't think foreclosures should be stretched out. I don't consider myself as a person who works with borrowers as somebody whose goal is to keep them in the house as long as possible, and then the foreclosure is going to happen. And most of the housing counselors who I work with across the state don't see that as their job either. There is a lot of talk about how the foreclosure process has been stretched out, and I won't go into the statistics and everything and the analysis we've done, but the reality is that a lot of the stretching out of the process is actually the servicer's own fault. It's about the way that the systems are set up and about the sloppiness and the inefficiency. A lot of the litigation under SB 1137 has been because people are so frustrated with a process that works so horribly, or doesn't work so horribly, I should say. And a lot of the scams that people end up succumbing to are because they are so frustrated with not being able to get help directly from the servicer. So from the vantage point of working with borrowers and talking with servicers and having this, actual communication back and forth every day, what I see is that asking that they do a better job of just being clear and clean and moving the process forward is not a recipe for delaying foreclosure. And I know we're not debating that bill, but I just want to address the point of the delay in foreclosure. I don't think is a necessary result of asking the servicers to do a better job. I think in a lot of cases it's the poor job that they're doing that causes delay. So.
And I would agree with something, and I forgot who mentioned it, but I think we need to have a greater concern on the REO market. in the old days, if you were a bank and you had an REO, you had to sell it for the value that you had left in the mortgage. If that amount in today's marketplace is less than you can get for the house, then bank, you just eat it. But I think to let these houses sit vacant for long periods of time, sell it for what you can get it for. I mean, I think we need to accelerate, in some cases, auctions. And if that house, again, if it doesn't bring but $70,000, if that's all you get for it, then that's all you get. But, providing this kind of, if we hold out, we may get 350 because the government will essentially backfill our, in effect, poor business decision. It creates a hardship on the whole neighborhood. I would accelerate the resale of those REOs. Clearly, you want to know that the person who's foreclosing has a right to foreclose, and I've seen some of that where, the real owner is a guy in China, and trying to get a document signed by the guy in China to produce the foreclosure becomes problematic because that loan got bundled with 1,000 other ones, and the people who bundled them never saw each other, and we were creating a scam. I mean, a lot of it gets scary, and I think we can settle it. But to me, the more simple, the better. If you didn't pay your house note for 6 months, then you know damn well you're about to lose it. And the fact that there's not a stamp on page 3 doesn't alter the fact that you ain't paid your house note in 6 months.
Did you finish that thought, Senator Wright?
I did. I said that, and I know they. Not that we disagree. We're probably looking at getting to the same place on different routes. I think markets kind of sort of work. People lose it, somebody else buys it, and oftentimes that loss becomes a great value, particularly to somebody who really wanted to buy the house. See, the fear that I'm getting in my neighborhood is that I'm not getting the opportunities for my local brokers and realtors to turn those houses over to people who'd buy them and live in them. And it's a whole lot easier in some cases where you get a house that was going to sell for like 200, but they'll sell 100 of them for 50 because the guy says, I'd rather take my 50 and get out of here. And then what happens is that it sits for a long time. It's somebody hoping again that the government will bail them out. And so there's kind of a second market risk while that neighborhood suffers in the transition. So I probably look at it a little bit different than do a lot of people, but I got people who will buy the houses at a fair price.
Right. Senator Wright, I just wanted to
briefly,
just very briefly.
But I do want to acknowledge that Senator Wright has a great interest in local realtors and some who aren't so local. It's a private joke.
The one point that I wanted to make, which I don't think has been made, is that there are some misalignments of incentives, of financial incentives between the servicers and the interests of borrowers and communities. And so in some cases, and there's a fairly large literature at this point, that many mortgage securities investors are very, very frustrated with the servicers because it's in their financial incentive. They have their own financial incentives for the sort of middle ground, the shadow inventory, the keeping the fees going on their late fees and penalty fees, and not moving the process to a prompt close. That's a big factor here, and that may very well play a factor also in the disposition of REO once they've already taken control of that property. So that getting the financial incentives as well as the regulatory ones aligned is really an important challenge for us all, I think.
Mr. Chair, I just can't let that go unanswered. Very quickly, the thought that a servicer is trying to prolong a foreclosure when they're not getting paid for, the average is 330 days in California. They're not getting paid. They don't get reimbursed for the time value of money. You typically have 2 to 3 or more months prior to even filing the NOD. So this concept that somehow servicers are prolonging on purpose to make more money is ridiculous. I just wanted to make sure.
That's probably a good note to end on. So because that may be someplace we can agree, because as I said earlier, it seems intuitively to me that the process isn't working very well for anyone. So that would make you suspicious sometimes, human nature being what it is, of why we continue to do it this way. So the purpose of this hearing, I think, was to have the initial discussion. We want to continue it, both in informational hearings but also individual discussions. Clearly, the purview of this committee is housing in California. We want a healthy housing market. I think most people would say that that's not probably the case for most Californians right now. So the degree we can engage you in a thoughtful process that maybe isn't quite the way you've gone through right now, where there's a lot of bills that come out ad hoc. I'd rather have a thoughtful process about acknowledging that the housing market's changed. It's broken for a lot of people, and how do we fix it as quickly as possible? So with that, we're adjourned. Thank you.